there's always going to be what's called defensive stocks. So if taxes do increase, the economy drops, defensive stocks and bonds will be preferred. And what's going to happen is if our current stock market is a little bit overvalued, which it is, if it's a little bit overvalued and all of a sudden the economy gets bad and stock market starts to drop because people are going to lock in the profits, they're going to sell their stocks and they're going to move into defensive stocks over here. So I'll talk about when this is going to happen, kind of what to take a look at. But if our economy does start to drop, we're going to take a look at defensive stocks and bonds. And when that happens, the stock market will sell because people will lock in those profits. And by the way, if you got some questions on this, just kind of let me know. And again, I know I talk pretty fast sometimes, and so you don't always get it. What to kind of expect in 2021? The stock market currently is completely overvalued. Let me see if I can pull up a chart here. And we'll just pull up the S&P 500, SPX. This is a chart of the S&P 500 index. And if I scroll down, I'm just going to scroll down here and maybe take a look at a 3-year chart. And here's what the 3-year chart looks like. This is a normal chart in this range right over through here. Make this a little bit larger for us all. This is 3 years ago, about 2 years ago. This is a normal range. It goes up, it goes down, it goes up, it goes down. And we had a nice rally coming into, and this is when the pandemic hit and everything sold off really quickly. And then what happened since that? Up there, we've just kind of gone straight up. This is a really big bounce. For those of you who've been in the stock market for a while, you know what I'm talking about here. From this low here back in April, when the whole stock market sold off, March, April area, to where we are today now in January, we've pretty much for the most part just gone straight up. This is a big rally. Normally you don't have a rally like that. This right here, this is 3 years ago, 2 years ago. This is normal. You have ups, you have pullbacks. We go up, we pull back. It's called an ebb and a flow. This is no ebb and flow. This is just a huge rally here. By the way, part of this ebb and flow, if we kind of go back through here, the S&P 500 is trading at 23 times forward earnings. Here's what that means, and I'm going to tell you kind of why we're overvalued when we talk about this. All stocks trade, and they're supposed to make a profit. And when they make a profit, they attract buyers. Typically, stocks trade at something called what's called a PE ratio, which just means price divided by earnings. And it's a really quick way to evaluate a stock. And I'll just pull up one so you see how this works if you're brand new in the stock market. I'm not quite sure what it is. Is there any stock that somebody would like me to pull up? And I'll cover that one while we talk about it. First one to type in the question and the answer gets it. I'm going to pull up PE by just looking for a stock.
Unless I got Tesla there.
Okay, I thought Tesla was the first one. Okay, TSLA was the first one. TSLA, your computer just saw it faster than mine did. I got GM, Peloton, and Tesla. Okay, so here's Tesla. Look at that chart, man. Boom, 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 boom. Let's pull back. Let's pull back here and just go to a 6-month chart, but just on a rally. It's because it was added to the S&P 500. But I'm going to go down here. Excuse me. This section right here is called the PE ratio. Now, it's the first item on our list. So on our list, we actually have some really cool proprietary tools on the InComparator website. And it tells you if a stock is a good stock, an average stock, and a bad stock. So if you're thinking about buying a stock, it tells you if it's good or not. And Tesla is an almost good stock. Think of it like a B stock, not an A or B or C or an F. A would be a good stock, B would be an almost good stock, C would be an average stock, and F would be a bad stock. But first thing that we take a look at, and for those of you who are in real estate, you kind of have the same thing. If you're thinking about buying a house, you look at what's the price per square foot. On the stock market, we look at something called the PE ratio, stands for price divided by earnings. And we take a look at the stock and say, and right here it says TTM, that stands for the trailing 12 months. In other words, all of last year, this stock every 3 months has an earnings announcement. It's kind of like a report card. So every 3 months, this company comes out and says, here's how well we did. Here's how much profit we did. Here's where our bills went to. Here's how much sales we did. But they give you a report card every 3 months called an earnings statement.